Okay, we looking good here. Hey, welcome to the Closing Beat, everybody. How we doing today? Happy Wednesday. Did you know it was Wednesday already? Bet you did. We are financial advisors here at Jazz Wealth. Hope you're having a good day out there, and thank you for watching, by the way. If you're watching, it's pretty impressive to us that you guys come around and check this out. We like to teach. I say this every day. We're advisors that teach. We care about you getting your dough straight, not just retirement, all the other stuff as well. And we're going to talk a little bit more about that in our Wine of Wealth class tomorrow, actually, Thursday. Last week, we did some strategic thoughts about your money, how to be strategic. Like, you don't have to be weird about it. Like, remember, does anybody go back enough where you remember American Airlines when they started making changes? They changed to lighter paper in their magazines and they saved 120 grand. The CEO said take one olive out of each salad and they saved like 80 grand a quarter or something crazy like that. You know, weird things like that. You can start thinking about that. Maybe you're not going to buy a white car instead of a black car because black cars weigh a little bit more, right? So you save on gas. I'm not talking about that, right? That's weird budgeting stuff that we can get creative about. I'm talking about strategery, right? If you do things within a year, it means you pay less taxes. It means you end up 3 years from now with more money than you would have if you did nothing. Those kind of fun things like that. Also, in our FinTips video, well, I can't remember his name, by the way, the American Airlines. I was trying to think of him. I really liked him. I think it was like Alan Mulally or something like that, if that wasn't it. But anyways, our FinTips videos are free. They're open to you on our YouTube channel. Hope you'll subscribe if you like what we're talking about there. Yesterday, I made the case for a soft landing-ish in the economy and in the market. And I'm slowly convincing myself more and more of that. So if you want to see the data that we use there, that'd be cool. Today, Eric covered the inherited IRA RMD rule. The IRS finally gave guidance on that. So what you got to do, if you inherited an IRA at some point from 2020 on, the rules just changed. So be sure to check out that video there. As far as the stock markets go, well, I probably don't need to tell you. Inflation is the focus now. We've got the CPI numbers coming out tomorrow there. I was diving in a little bit more on that, trying to use what I like to use to look at that stuff. I'm now going to go 8.1%. I was at 7.6. I'm actually going to raise it. So inflation's like 8.25, somewhere in there right now. I think it's still going to come down, but I'm going 8.1 will be the actual headline CPI year over year number if you're tracking with it. I was going to go 7.6 and I was thinking 7.9. I found some ways to convince myself 7.9. I'm going 8.1 tomorrow, but we're going to find out, like it or not. It's going to be there. And by the way, I love how they're framing this. You notice how they're like, we're going to raise rates until we beat inflation, like we're all together, like America. We're fighting this war against inflation. No, that's a clever way of saying, you stop spending money. We're trying to get you to stop spending money. We're trying to get you to hold back a little bit and maybe just buy the necessities, right? So really the Fed is telling us we're fighting inflation. They're fighting us. They're trying to tell you, don't go buying a house. What are you doing? Well, the prices are going down. So read through that. Really understand that, corporations are adjusting. You should adjust your personal finances as well. But that's a separate topic we could just go on and on and on about. Also, we got earnings coming up. Did you know? So typically as we go into an earnings season, if there's going to be a reduction in the earnings expectation, it averages about 4%. So analysts typically get it right within about 4%. And as we get closer to earnings, there's a lot of companies that pre-announce. Actually, 29% of the S&P pre-announce their earnings. But typically, analysts are like, well, I know I'm within plus or minus 4%. We get closer, they tighten it up. That's not the case this time. They were plus or minus 4%. They thought they had it right. Now we're 7% lower on expectations there. So they've really lowered the bar. That is a recipe for companies to come out and beat those now lowered expectations, right? If I told you I had an expectation that you have dinner ready by 5:30 and I change it and I say, if you have it ready by 7:30, then I'll be happy with that. Well, if you have it ready by 6:30, I'm still happy, but you still got to wait. Right? You get what I'm saying there? Maybe that's a bad analogy, but I'm from Texas. I do those kind of things. Anyways, that's the earnings there. 9 of 11 sectors, if you're looking at the S&P, have seen declines in their earnings. The energy sector is the only one that's seen an increase in expected earnings there. So just a heads up for that one there. The issue, though, is if we beat on earnings, and a lot of companies end up doing that, it's not going to move the market. Just the beat on earnings won't move the stock or move the market. The focus is going to be on forward guidance, if there even is any. A lot of companies are choosing not to give guidance now going forward because they're sort of clueless what the Fed's going to do and how the economy is going to handle that. The secondary focus, you want the buzzword? Here's your drinking word of the day. It's a phrase. You're going to hear the words currency headwinds. Probably the most you've ever heard it before. Remember, last quarter was inflation. You're going to hear currency headwinds a lot because the dollar's already up 20% year to date. 14% of that's come in the last 6 months. And so the concept there is when a company has, I pushed the wrong thing. When a company has a lot of their earnings overseas, they make their money in that currency. They convert it back to the dollar, and that's less in sales, right? Because they took a hit to convert to a strong dollar. So down here, the currency is worth this. Convert it to the dollar. The spread's too wide. Oh my gosh, we didn't make as much as we thought we did. So that causes issues for companies that do a lot of revenue overseas. In that case there, I hope I said that right. I usually say that backwards, but I got it right that time there. So what you want to be on the lookout for, companies that will likely be affected by this are companies that have lots of their sales happening overseas, more than 50%, right? Put together a little list for you. Let's see if I can do this and see if you even can see it. There you go. It's a little small because I wanted to get as many names as I could on there. All we're really showing here, the top name is Newmont Mining. They're in the materials sector. It's a gold miner. What I have is this column, or these two columns here, are U.S. sales. Then I put international sales over here, right? I took out a lot of names that just probably won't see much attention. So for example, in the international camp here, 99.2% of Newmont Mining's sales come from outside the country. When they bring those dollars, or some of those dollars, back to the U.S., it's going to cost them, right? Whereas nothing's changed compared to a year ago. So if you want to look at something, Estee Lauder, where'd it go? Right there. So Estee Lauder, consumer staple stock, lotions, potions, and makeup. Most recently, they have 73% of their sales coming from overseas. That's an increase because a year ago it was only 68%. That's a bad time to have an increase. You're selling more, but it's costing you to get those into dollars, so this likely is something that offsets here. Look at something like PVH, Ralph Lauren, Tommy Hilfiger, things like that. 65% come from overseas, 56% just last year. So it's great that they're selling apparently like hotcakes somewhere else, but when they come in and bring them back to dollars, you're going to hear PVH say currency headwinds. You're going to hear Estee Lauder say currency headwinds. Schlumberger, currency headwinds. Intel, they've got a lot of things they've been saying here lately, but they're going to say the same thing. Las Vegas Sands, maybe not as bad, but you're going to hear that there. So there's a little bit of a list of stocks that likely feel some pressure going into earnings, even if they beat earnings. It could just be great for them. And they do really well, but that's what you're going to see there. Anyways, I just want to put together a list. I try to find creative ways to put together lists that are either ideas or warnings or maybe sells or whatever without me actually saying that, because I'm not allowed to actually say that. And we do like to, stay out of trouble. Anyways, let's take a look at the stock market here. You got the S&P sitting at lows, looking like it wants to break down under those lows. It was a choppy day because, well, inflation. You got inflation and earnings. There's a whole lot of data coming here at the end of the week where we typically don't see that kind of a thing, especially when we're starting earnings season, right? If we're outside of earnings season, typically Fridays are pretty quiet. There's not a lot of econ numbers and not a lot of stocks report their earnings on a Friday, but all that changes this week. So we're likely going to see some action here. Like I said, it looks like the market is trying to tell you, hey, every rally has failed over the last couple days, and we're likely going to break this low. So that's the case there. Just know inflation and earnings. Those are your big topics there. That's likely where you'll want to focus in the next couple of weeks anyways. Remember, earnings season ramps up and then it peters out there. So that's what's going to happen this time again. Now, I made a case in the video yesterday for a softish landing in the economy and stock market, meaning that if we have a recession or we agree to define it as a recession, it's not really going to be anything. We're going to be just fine. And I put together some notes, because I'm going to debate this with Eric, he doesn't know this yet, in our Friday video. So my argument is that what the Fed is doing right now is actually working exactly as they wanted to. They get to raise rates, and try to fight inflation, but you get to keep your job. They keep saying they're going to be aggressive. They're really, really hawkish is the term that they use. But it's going quite swimmingly from all data points that you can look at. That's my argument there. The markets have already priced in the additional rate hikes. That's number one. Number two, rates are higher and everybody that wants a job can still get one. That could change, but so far that's going well. The bond market correlation to stocks is weakening. That's actually great news there. That means that the bond market is starting to move on its own, and as well as the stock market, but the bond market's the focus there. The midterms. Did you know that midterms are actually a bullish time of year? I was going to do some videos on this, but I'm going to share this with you here. You guys are here right now, right? We know we have the midterm is a month away, right? 1 day left, 1 day short of 1 month away. And the 4 months after the midterms tend to outperform any normal 4-month period in the stock market. Yeah, that may not mean much right now because outperforming could mean we fall less than the market normally falls. But if we look at the 4-month average and we go back as far as we absolutely can, let's take a look real quick. You came for some good stuff. Let's give you the good stuff. So here is, what we did is we put the median volatility of the stock market. Doesn't mean gains, it means median volatility. We know that volatility is going to increase. This is right here just before the midterms. Like I said yesterday, we already have high volatility, so this may not even be all that noticeable because right now, if you were to measure the market, we're like here, right? So a little bit more volatility, is that really going to bother anybody? Normally, it'd be a big deal. We start off through the year, come out of a quiet summer, and in a midterm year, oh my gosh, they're fighting. Everybody hates each other. This is crazy. Who do I vote for? I don't know what to do. That causes volatility because how you vote determines what bills may get passed, which means how it may affect public companies, which means it could hurt or help earnings, right? So that's the reason why midterms are so important. As we go through, we find that volatility beats the market's performance. Right? It beats the market's normal volatility. So volatility is still high. However, performance tends to be very, very good. And I don't have that freaking chart on here. I'm going to do a separate video for you. I just wanted to share that for you, but I pasted that chart somewhere else. You should know that that is the case, right? So we are already in the best 90-day period, which is my fifth point there. We're in the best 90-day period of the year. We know to expect movement. We know the third year of any presidential cycle is always the best year. I shared that with you yesterday. So I did share that with you. Okay, so I feel better. And the other thing, a point I want to make, which of course is data oriented, right? I'm going to share that with you because you don't really care about my opinion. The other point I'm going to make is this. I'm using our research platform here that's available for clients and research members if you want to check it out. But the market is down 12% over the last month, right? Okay. Is that a lot? Is it not? I don't know. So what I thought to do is let's see how often a month, an actual calendar month, finishes down 12% or more. Is that normal? Because that seems like a whole lot right there to fall 12% in a month. I don't know, right? Take a look. So my last case for a market, I don't want to say bounce, but end to the nastiness we've seen, is there's only 3 other times in 30 years where any calendar month has fallen 12% or more. And notice they were in the middle of absolute chaos. The dot-com bust there or leading up to it. You got the 2008, this is the, we call it, let's just say GFC, Global Financial Crisis there, typically is how I type it out. And then of course, COVID. What's this one? Is this chaos? No, it's uncomfortable, but it's not chaos, right? So we lost 14%, 16%, and 12%. That's the only times in the last 30 years that that's happened there, right? Looking at the months before, we were already selling off anyways. We just happened to have a flush out in the month after that. Well, what happened after the flush out? Oh, most of the time it was positive. Only in 2008 when, boy, that was nasty. Those of you that lived through it, this is a cakewalk, right? That's the only year where we had some problems. So in short, what I'm trying to say is that there's a case to be made for good. Don't let doom and gloom ruin your whole life there and just go through this whole thing there. We have a case for people that still have jobs there. The bond correlation's disconnecting like I mentioned there. Midterms are likely to be bullish. Rates are higher and everybody's got a job. Best 90-day period ever as far as the whole year goes. And in just 1 month, we're down 12%. But markets don't fall 12% in a calendar month. Is that a recipe for a bounce there? So take a second and let's just see the sunny side of things for a chance, because the markets will bounce during doom and gloom. Always happens, right? So every time I've shared that with you guys, we talk about where the market bounces relative to a recession, where the market bounces relative to a war, where the market bounces relative to the financial crisis. Were we out of the financial crisis by the time the markets bounced? Absolutely not. We had more than double-digit gains by then. So we've got to, if you don't believe it that it's now, that's okay. You got to believe that the market will bounce when things still seem kind of rough out there, right? Don't miss those days. That's a big one there for you. Anyways, I rambled a little bit there. Let's go on to stocks in the news for the day, because I do need to cover some of that stuff. Let me get my mouse to work here. Sorry about that. All right, GE. There you go. GE is in the news there. Good 1% gain for that one there. They are going to spin off, finally, their healthcare division. This has been argued for, well, let's say decades now, that they do this. They are officially going to do that. They have filed the paperwork. It is not a rumor. It is happening. We've got Intel just laying off thousands of people. They didn't give a specific number. They said, we're going to lay off thousands of people. So they are preparing themselves, obviously, for tough times for them. By the way, AMD is just kicking their butt, so understandable there. Pepsi. The only reason I get to say I told you so is because I told you ahead of time. That's my rule. I never say I told you so unless I actually told you before something happened there. I had mentioned on Monday that, what did I actually say? I keep records of this stuff. So on Monday, we talked about Pepsi. I said, I expect them to beat on earnings, revenue, and they will report higher organic growth. This will offset their lower margins. Organic growth should be double digits. Margins down by 0.3%, and Latin America, because of Brazil, will be the highest organic growth there. That's just because I had nothing to do over the weekend, guys. I'm not trying to show off here. I was so bored. But just as I said, organic sales. Well, first of all, they beat on earnings, beat on revenue, raised their guidance. Organic sales up 16%. I only called for double digits. That was a fancy way of saying 10%. And where were their sales largest? It wasn't Latin America. I didn't get them all, okay? It was Europe. But Latin America came in a very close second there. Some of their larger, well-known brands like Doritos, Cheetos, Lay's, Ruffles, Tostitos, and Fritos, they just own all the chips. Double-digit percentage net revenue growth. Smaller, I don't know that they're smaller, actually, but the healthy foods out there. Popcorner, Smart Food, Bear, and Sun Chips. Oh, those are good chips. Also, double-digit growth. They're killing it. This was a really, really good earnings report for Pepsi. Far beyond what I had expected, but still really, really good for them. And if you look at the charts, of course, they enjoyed a very much above average day, 4.1%. Good for them. This one's here for Charlie. Charlie left KnowBe4 to come work with us here at Jazz, and his company is getting bought out by a private equity firm. I think it's Vista Institutional. So they're buying them out. That's why you see the stock up and stuck right there. So there you go. Also, you got Diamondback Energy in the news as well. They are going to buy Firebird. Not really a big mover. I found it interesting that the stock actually moved higher on this news. So Diamondback Energy is going to be buying Firebird. I think it's a couple billion, not much more than that. 1.6 billion is the actual number there. And those are your stocks in the news for the day. I'll take your questions if you happen to have any questions. Otherwise, we'll get back to the goods. Get back to work. That's what that means. Let's go back over here. I can see your questions. I'll try to pop them, make them nice and big. Michael says, man, we're going to have a 12% tomorrow when the CPI number comes out. You want to bet? I'll take the other side of that bet. I would like the market to fall a little bit more, but I will bet you that doesn't happen. Yeah. Nice. Oh, Craig made a little money on that Pepsi. There you go. Oh, nice. Pepsi is on a tear, and that earnings report, boy, if our earnings season as a whole turns out to be like Pepsi, honestly, it's probably bad news because the Fed probably goes, oh, okay, there's room to get going there. We can do even more. Yeah. You don't like the purchase there? I didn't get a chance to read much about it. I'll be honest there. Dustin, hey, cool name. Since the 60/40 portfolio is so poor this year, does it make sense to switch to the S&P during recovery? Oh, that's a good question. It's a really tough one because generally you'd have to say no. Now, you're not an older fella, right? So if you happen to be in a target date fund and you go, wait a minute, this sucks, man. I've got a long time until retirement. Could you get more aggressive? Would now be the time to do it? Yes, because this is an odd time where in your portfolio, 60/40, right? This is down and this is down. So normally when people want to switch, you're like, it's a tough one because your bonds are killing it and stocks are a little weak. You're not doing yourself really any service to move to something more aggressive. Now we have a whole portfolio down. So you're increasing the volatility, the risk, the growth profile and everything by switching. So if you have enough time until you need that money, now you got something. And remember, there's only 3 other years in history that you could say that that's the case. So that's why I say, you know what I mean? It's not normal to say that. No other advisor is going to be like, no, just stay the course. Or no, I'm sorry. They wouldn't say, yes, make the change. They're going to say, stay the course. This is only the 4th time in history, and this is the worst one, by the way, that you could actually do that, and it makes sense to do that. Yes. Yep. So we're probably up to 30% of the S&P is now pre-announced as well. Semiconductors were one of the leading industries to pre-announce their earnings because they're having a rough go of it. Are they due for a bounce, by the way? Is there an argument? Have you seen the relative strength from the semiconductors compared to the market? Is that showing you something? Is that maybe a little bit? I don't know. Hey, Dustin, would you wait until after earnings to add to positions, especially financials? Only because we're just days away, right? If this were, hey, earnings are next month and I was thinking about doing something, you go for it. Don't worry about that. But because we're only a day away, 2 days away from the start of it, what's it going to harm? You know what I mean? Yep. You like Schlumberger to add to it? So based on what we talked about today, should you add to Schlumberger? Is it the best possible time? Remember, we're so quick to move our digital dollars all over the place, but those are still real dollars. Is every time you make a move, is that the best thing you can do with your dollar? Or should you do something else, right? That's what I'm trying to get people to think about, right? What's the best use of every single $1? I don't think it's the best use of your dollars right now with what we now know. Do you think inflation will increase tomorrow? I covered that in the beginning. I do not think it will increase. I think it will drop to 8.1%, which is the main number that we all look at. So it'd be a drop of about 0.2%. No, almost 0.2% month over month. So you know how they report it, right? They'll say, inflation's month over month up by X or whatever it is. That's the smaller number. The larger number is where do we stand compared to last year? That's the 8.26 or whatever it is that you see right now. I believe it's 8.26. Is that a Nerf gun? Yeah, it absolutely is. We have 2 of them, by the way, so watch out. Oh, they're both right there, actually. So apparently we keep our guns in the same spot. I like it. Oh, man. I love that you guys, look through these things. Some of these questions are, right, one level higher. You know what I mean? Aside from just you think it's a good time to buy this stock? Well, what's your analysis? What do you have for that reason there? That's awesome. And I just noticed the question there from Tyler from Canada, about to finish university. Congratulations. Any tips on becoming an advisor? I hear it's a better business here in the States. So if you're looking to move to the States, maybe something there. But tips on becoming an advisor is if you don't have, show, and just possess that absolute die-hard, money-driven, not to be rich, but to look at how every dollar generates some sort of alpha, right? If you don't have that inside of you, you got to find that because people pick up on that. If you're the advisor that's I want to pick this mutual fund and I think you should be in that one. What? Where's the energy? What is that? Why is it that one, not this one? Why is it not this mutual fund? Why is it not that stock mix? Why isn't it that ETF? So there's got to be that drive to be this is what I want you to do, and I can prove it to you. I can show you why it's better. And you'll do just fine, man. You will be just fine. Don't you worry about it. Hey, wish you luck, by the way. Keep me posted on how you do there. I'm going to wrap it up here and get back to work, do what I've got to do. I hope you enjoy the rest of your evening. And we will see you tomorrow again for this show, as well as the Wine and Wealth. I look forward to that. Always do. If you're not a client of Jazz Wealth, Wine and Wealth is just a private class that we do for clients every week where we can get more specific, more detailed, answer more direct questions, and really strategize, keeping you up to date on how to keep your dough straight. And so I love doing that stuff. Grab a drink, come hang out with us, and I'll teach you something. You think I've taught you something here? Teach you something there. All right, enjoy the rest of your day, and thanks for coming by. See ya.